Welcome back, fellow investors. Previously on Mistakes in Investing by Beginners.
In essence, it is desirable to avoid making a multitude of these typical mistakes.
If you've missed the first part of the common mistakes in investing by beginners, don't worry. We've got you covered. Just click the link in the description below, or you can find it by clicking on the card above. Get ready for part 2, where we dive into 5 more common mistakes done by beginners in investing. The wait is over. Let's uncover these mistakes together. Investing mistakes often stem from a lack of patience. Immediate gains should not be expected when investing for the long term. It takes time for new strategies to unfold and show their effectiveness. The S&P 500 index, for example, has had an average annual return of 9.1% between 2000 and 2021, despite experiencing negative returns in certain years, like during the Great Recession. The power of compounding is a key factor in profitable investing, but it requires time to achieve substantial results. Starting early and saving for retirement tends to yield the best returns. Receiving stock tips or information from unreliable sources is a widespread and costly mistake in investing. Many self-proclaimed experts are eager to share their opinions, presenting themselves as knowledgeable and infallible. Even stock analysts employed by investment firms can make mistakes, despite having a solid understanding of the companies and industries they cover. In other words, their qualifications don't guarantee accuracy. In general, it is advisable to seek investment advice or guidance from government-backed sources and nonprofit organizations. Consulting a financial advisor can also be beneficial in navigating the investment process. Another example: to subscribe to our channel and to watch previous and upcoming videos to enhance your literacy. It's important to remember that even the most experienced and successful investors cannot accurately predict the future. If an investment professional promises guaranteed outcomes, it should be viewed as a warning sign. An investing mistake to avoid is blindly following the crowd without conducting proper research. Often, investors hear about a successful investment only after it has already performed well. Mainstream media tends to cover these popular investments, but by that time, the stocks may have reached their peak and become overvalued. One example is the GameStop stock hype in 2021, where latecomers ended up losing money. It's important to conduct independent research rather than relying solely on what others are doing. Averaging down, the practice of buying more shares at a lower price to offset previous losses, can be a costly mistake in investing. It is often used to hide the magnitude of losses, but involves investing more money in a declining trade. Averaging down is driven by the sunk cost fallacy, where individuals are reluctant to change their behavior or beliefs due to prior investments. A better approach is to average up, buying more shares as the stock price increases to confirm a sound investment decision. Failure to perform due diligence when investing can lead to costly mistakes. Venture capitalists and investment funds regularly conduct due diligence to make informed investment decisions. Individual investors should also prioritize thorough research, especially with speculative penny stocks. By conducting proper due diligence, investors can mitigate risks and avoid negative surprises, resulting in better investment outcomes. While it's best to avoid these common mistakes altogether, it's inevitable that investors will make some of the errors we've discussed. The good news is that you can embrace a growth mindset and learn from these experiences. In fact, losses often provide greater lessons than gains. With time and experience, you'll likely find yourself in a more advantageous and profitable position. The key is to recognize and rectify these common mistakes swiftly, ensuring that you have sufficient funds remaining for future investments and to understand how the stock market works.